Hello and welcome to our College Savings webinar. May 29th is celebrated as 529 Day, making this month a perfect time to raise awareness of the benefits of saving for college with the 529 plan. Today's webinar features Kathryn Flynn, Editor-in-Chief of Saving for College, who will walk you through the basics of how to save for college and how to get the most out of a 529 plan. Tim Gorell, the Executive Director of the Ohio Tuition Trust Authority of College Advantage, is also here today to help answer your questions. I'm Martha Kordiak-Mert, Chief Operating Officer of Saving for College, and I'll be serving as the moderator today. First, a few housekeeping notes. We are recording today's webinar and we'll share a link to the recording in a follow-up email. In that same email, we'll include a link to download today's presentation and a super short survey to get your feedback on the webinar. We encourage you to ask questions throughout the presentation. We'll be answering those questions along the way, and we'll also save about 10 to 15 minutes at the end of the webinar for additional Q&A. Please enter your questions for our panelists in Q&A, not the chat. We'll be putting some links into the chat, and so we'll have a better chance of seeing your questions if you put them in the Q&A. If we don't get to your question today, please visit our forum at forum.savingforcollege.com to try asking your question there. Today's webinar is brought to you by Ohio's 529 plan, College Advantage, the plan that can. I want to let everyone know that College Advantage is kicking off National 529 Day by giving away 2 college savings awards in partnership with 2 of Ohio's professional sports teams. We'll share more information on how you can enter at the end of the webinar. And now let's kick things off with a poll question for our audience. The question is, do you already have a 529 plan? Yes or no? So I am launching that. And if you could go ahead, take a minute to respond. And once we have a few of the responses in, we'll end the poll and share the results. All right, looks like about 80% of people are in. So I'm going to go ahead and end the poll. And let me share the results. It was, for a while, it was a perfect 50-50 split, but we have 49% say they have and 51% say they haven't. So this is great. We've got a mix of folks, and I'm sure you'll have some different questions depending where you're at. So Tim, it's great to see that so many people have started saving with a 529. And I wanted to ask you a few questions before we get into the presentation. Let's start with the folks who haven't opened a 529 yet. What advice would you give them as they research their options?
Well, one, I think I urge you to start saving and investing. There's likely going to be education expenses after high school for your beneficiary, for your child, your grandchild, and there's going to be costs affiliated with it. And you may not know right now whether they're going to an in-state, 2-year, 4-year college, or a trade school, or a technical school, but there will be some costs associated with that. And the best thing to do is to start saving now. The enemy here is student loan debt. Latest estimates have student loan debt in our country upwards to $1.7 trillion. And there's nothing I think would be more challenging than to come out of an education opportunity to an exciting career opportunity strapped with $40,000, $50,000, $60,000 plus of loans. And for the foreseeable future to be paying off of that coming out of your salary. So a better way to look at this is plan, have a direction of what you want to save for, picking some school, whether it's in-state, out-of-state, whatever the case may be, and begin saving for that option. For those that already have a 529 plan, please continue to keep saving. You're doing the right thing. And even though you may have started off modestly with your investments, whenever you can, upward, increase that. And again, also look at what you're looking to save for and how much for that opportunity.
That's great. Those are great insights, Tim. I really appreciate you sharing that. We always like to say save early and save often, even if it's small amounts, right? Just whatever you can afford, it'll make a difference, right?
Absolutely.
Yeah. All right, that's fantastic. So Tim, we're going to come back to you during the Q&A session at the end of the webinar. For now, I'm going to go ahead and turn it over to Kathryn Flynn to begin our presentation. Katie, you're on mute.
Thank you. Thanks, Martha and Tim. I'm really excited to be here today to celebrate 529 Day, which is now officially recognized as National 529 Day. I have some firsthand experience with 529 plans. I'm a mom to 3 wonderful kids who each have their own college fund. And so I know how important it is to not only get started with saving for college, but also to stay on top of your plan and make sure to check in along the way to ensure you're reaching your goals, just like Tim mentioned. So with that, let's go ahead and get started with the presentation. We're going to start by looking at several popular options for saving for college. At Saving for College, we get a lot of questions about using different types of accounts to save for college, such as a Roth IRA. As you can see from the table, a 529 plan is going to be one of the more flexible accounts you can use, and which is why we, most often recommend 529 plans as the best way to save for college. A couple things I want to highlight from the table. First of all, income restrictions. So as you can see, if you're a high earning family, you're going to be restricted to the type of account you can even use. So for some families who exceed certain income limits, options like a Coverdell Education Savings Account or a Roth IRA are not even available for you. So you're left with choices like a 529 plan or an Utma account, which is a custodial account under the Uniform Gift to Minors account, or the Act, or the Uniform Transfers to Minors Act, which are investment accounts for children. So the other thing you want to consider, though, is even if you do meet the income requirements for the Coverdell and the Roth, these accounts have contribution limits. So with a Coverdell Education Savings Account, which also offers tax benefits for saving for education, you're limited to contributing only $2,000 per year per beneficiary. And with the Roth, that's limited to $6,000 per year, or $7,000 if you're over 50. So depending on where you are and what stage you're at in the college savings game, that might not be enough to reach the goals you're aiming for. With 529 plans, there are no annual contribution limits, but each plan has its own aggregate limits, which is determined by the state. And the highest right now is up to $529,000. So for most students, that's going to be more than enough to cover the cost of a pretty expensive college education. The other thing you want to compare, because you want to get the most out of your savings, is the tax benefits. The 529 plan and the Roth IRA work pretty similarly, where the investments grow on a tax-deferred basis and in some cases can be withdrawn tax-free. The big difference is with the 529 plan, those tax-free earnings can be withdrawn tax-free at any time to pay for qualified higher education expenses at any time. But with the Roth, you're a little bit more restricted. You can withdraw your contributions at any time, but in most cases, you have to be at least 59.5 to withdraw the earnings tax-free and penalty-free. There is one exception with the Roth. You can take out money to pay for qualified college costs, and then you won't owe the 10% penalty. However, you'll still owe taxes on the investment earnings unless you meet those other requirements, like being 59.5. So overall, the 529 is going to be one of the more flexible options here. We also want to talk about the qualified expenses. So another thing to consider is how you can use each type of account. With the exception of the Utma account, you typically have to use the funds in these accounts to pay for certain school-related items in order to get the tax breaks. So 529 plans, as you can see, offer a broad range of qualified education expenses. And in recent years, that list has expanded even more. For example, you can now use a 529 plan to pay for up to $10,000 per year in K through 12 tuition. You can also use up to $10,000 to repay qualified student loans. So that opens up the door for families who might have been, a little hesitant to use 529 plans. What do I do if I have money left over? Now you have more options how to spend that money tax-free. If you do end up taking a non-qualified 529 plan distribution, meaning you withdraw the money and spend it on something not on this list, the earnings portion is going to be subject to ordinary income taxes and a 10% penalty. So to explain that a little more, when you take a 529 plan withdrawal, there's going to be a contribution portion and an earnings portion. So the contribution portion will never be taxed or penalized, but that earnings portion, you're going to have to pay income tax and a 10% penalty if the withdrawal is considered non-qualified. If you did receive any state tax benefits, they might be subject to recapture by your state, depending on where you live and what kind of benefit you received. So now that hopefully I'm convincing you to look into 529 plans, let's talk a little bit about how they work.
Katie, one quick question. By the way, there are a lot of questions coming, but I'm going to just focus on what you talked about. Someone asked about, actually Andrea asked about can you convert a UTMA to a 529?
Yes, there is a way to convert it. You'll have to look into your specific plan and talk to them, because it'll work differently with different plans, but you can do that. And I believe it has to be a custodial 529 plan when you do the conversion. But yes, so you'd be able to benefit from everything we just talked about.
Thank you.
Okay, so what is a 529 plan, for those who don't already know? So a 529 plan offers a great mix of tax and financial aid advantages for families saving for college and also K through 12. Most 529 plans are state-based, and all but one state, which is Wyoming, offer at least one 529 plan. Many states have even more than one 529 plan. You're probably wondering, so do I have to use my home state plan? No, you don't. Many states, even if you live in Wyoming, which doesn't have a 529 plan, you can use one of the other many plans that are available nationwide. So you just have to look into your state and see what's available, and see what options are available to you. The tax benefits, however, work the same for all plans. What's going to be the difference between all these plans are things like the investment options that are available and different features that plans might offer, such as gifting platforms. And what that means is some plans offer gifting portals where it makes it easy for grandparents or aunts and uncles to contribute to a child's plan. So there's so many different plans and they offer all these different great features. So it's important to research and see, what works best for your family.
Katie, since you just mentioned gifting, Clarissa asked, if relatives give a gift in a 529 account, can they get a tax break also?
That's going to be depending on where you live. I believe there are 10 states that offer the tax benefit only when it's actually going to depend on where you live and the rules for that state. So some states only give the tax break to the account owner, and other states will give you a tax break no matter who you give a gift to. So you're going to have to look into your own state's rules for that one.
Thank you.
So we'll talk a little bit more about the biggest benefits that 529 plans have to offer. So one of the greatest benefits and what's going to help you save the most money for college is the tax benefits. As I mentioned, a 529 savings plan works like a Roth IRA. You deposit after-tax dollars, which are then invested into mutual funds or other similar investments. So these investments grow tax deferred and may be withdrawn tax-free as long as the funds are used to pay for qualified education expenses, which we talked about on the previous slide. So the power of this tax-free compounding is what's really going to help you save for college. For example, if you were to save just $250 each month from the time your child is born, you could have about $95,000 by the time they start college. And I mean, that's going to depend on the rate of return on your investments, but that's just an example. And then another thing unique to 529 plans is that state tax benefit. So over 30 states are going to offer some sort of tax break for your 529 plan contributions, which can help you save even more. Another unique benefit, which we talked about just a second ago, is crowdfunding. So anyone can contribute to your child's 529 plan. So you probably want to think about that next time a grandparent, friend, or other relative asks what your child wants for their birthday. I mean, you can think, do they need another toy? Even a small contribution to a 529 plan will grow over time. And today, most plans make it really easy to ask for and receive electronic gifts. Especially, Good times to ask for gifts is probably when the child is a baby or maybe a teenager approaching college. The older they are, the more they'll appreciate the value of the gift. Um, Next benefit is the flexibility. So if you open a 529 plan, you're not locked into that plan forever. You can decide to roll over to another plan if you move. Maybe you want to take advantage of a different state tax benefit if you move to another state. You can always change the beneficiary of a plan to a qualifying family member, which includes siblings, cousins. There's a lot that qualifies for a family member. They can be used at any school that is eligible for federal financial aid. So that could be a trade school, it could be a community college, a private four-year college. There's a lot of options there. And then, as I said, you're not locked into the plan, and you're also not locked into your investment options. So when you set up your plan and you pick your investment portfolios and you decide you want to change that, you can change your investments without any tax consequences twice per year, just in case your situation changes. And then, as I mentioned, 529 plans are going to allow you to really accumulate savings by the time your child gets to college. And as we know, college is a major investment for most families. The average cost of tuition, fees, room and board at an in-state public university right now is close to six figures, and it's rising at a rate of about 3% each year. I mean, that rate of growth has gone down in recent years, but it's still rising and it's still very expensive. So like any investment, it pays to start preparing as early as possible. This chart here illustrates the difference in how much you can save if you start when your child is a newborn versus waiting until college is 6 years away. Honestly, it's really never too early to start saving. If you know you're going to be paying for college one day, you should go ahead and start saving now. There's no reason not to. On the other hand, it's never too late. Even if you have a child in high school, you have more time than you think. Even if there's only a few years, you can still build some savings. And every dollar that you put away today is one less your child will have to borrow in student loans. There's also other ways to boost savings if you have an older child, especially if you qualify for a state tax break, you can reinvest those savings. And ask for friends and family to help. College savings contribution makes a great graduation gift for a teenager.
Katie, you mentioned that, so a bunch of questions have come up, but now you mentioned that it's never too early to start saving. Can you talk a little bit about how you can set up a 529 if you don't have a child yet, or if your child doesn't have a social security number yet?
Absolutely. So the way you can do that is, whether you're having a child or you think you are going to one day or considering it, you can always set up a 529 plan account in your own name with your own social security number. And then once your child is born and has a social security number, you can change the beneficiary on that plan to your child. So this could come in handy if you wanted to do something along the lines of a baby registry and have the child's 529 plan account on the registry. Even though they're not born and they can't technically have their own account yet, you can still start funding the account in your name and then change it to the child's name later.
Great. Okay, a couple more questions. Mick asked, does the educational institution that you're using the 529 plan funds have to be located in the US?
Not necessarily. There are some international schools that will accept 529 plan funds. So again, you just have to check and make sure. We do offer a tool on savingforcollege.com. It's called Is Your Institution Eligible for 529? So you just want to go ahead and make sure. And that's also true for some study abroad programs. They also accept 529 plan funds.
All right. A bunch of people asked about rolling over from one 529 to another. So can you switch from one 529 to another?
Yes, you can switch to one 529 plan to another. The IRS does limit that to once every 12 months. So once every 12 months, you can go ahead and switch. And the way you would do that is you just visit your plan's website and you'll be able to download a rollover form. Some plans might let you do it online. Otherwise, you'd have to download the form, and you would just put in the amount that you want to roll over and the information on the new plan.
Okay. And then the last thing, somebody said that they missed what you said about changing twice per year. I think that was on the investments. So can you just repeat that?
Sure. So that was referring to the investments, which is different than a rollover. So the investments are going to be the investment portfolio that's within your plan. Let's say you picked a conservative portfolio and you decided you wanted to go a little bit more aggressive. You can go into your plan and pick a different investment portfolio, but you're limited to doing that twice per year.
Awesome. Okay. Thanks, Katie. We'll let you move on to the next section.
Sure. So the next section is how to get started with a 529 plan. So as you know, there are so many different plans. So step one is to choose the type of plan you want to start with. The two ways plans are sold are either advisor sold or direct sold. Direct sold plans are typically offered by your state, and advisor sold plans are sold by financial advisors. So advisor sold plans may cost a little more. They typically have higher fees, and that's because they charge commissions and they have higher expense ratios than the direct sold plans. But it's kind of a matter of you might be getting what you pay for, because with the advisor sold plans, you're going to get the professional guidance that the advisor offers and who are going to help you find and select your investments. Whereas a direct sold plan is a little bit more DIY. We'll discuss that a little bit more in our following slides. But what we'll talk about next is the two main types of direct sold plans, 529 savings plans and prepaid plans. So another thing you'll have to decide is if you want a prepaid tuition plan or a 529 savings plan. So a prepaid tuition plan is a little bit not as widely known as a savings plan, and these work more like a pension plan, whereas the savings plan is going to work more like a 401k. So the prepaid tuition plan, they let you pay for future college tuition at today's prices, generally. And this provides parents with some peace of mind. You want to lock in those costs today and know what you're going to be paying for in the future. Only a handful of states offer prepaid tuition plans, and sometimes they are designed to pay for a public college in that state. They usually have residency requirements also. Another option is a prepaid tuition plan that's offered by private college, which is called the Private College 529 plan. So that one is not state specific. But I think what most people are interested here today is probably the 529 savings plan. They're much more popular. And the difference is that these plans, the investments in a 529 savings plan can lose money, but you can also benefit from the investment returns. Another thing folks like is that you can manage your risk by controlling your own asset allocation. And there's just different investment options to choose from. All 529 savings plans offer an age-based asset allocation that starts off aggressive when the child is young and gradually shifts towards a lower percentage of stocks as the child approaches college. So that's kind of what I meant on the previous slide when I referred to the DIY investing. So although you might, even if you're a little bit intimidated about selecting your own investments, know that the plans offer these age-based portfolios, which make it pretty simple for you to go ahead and pick something. If you're a risk-averse investor, college savings plans, a few of them also invest in FDIC insured products or CDs, which are typically good for either an investor who's risk-averse, or maybe if you have an older child and you're worried about protecting your investment and you don't want to put in too much risk right before they start college. And again, direct sold plans, they're offered by the state, or advisor sold plans, which are sold by financial advisors. And that when I say offered by the state, if you're wondering how to get one, you can just, you can go on savingforcollege.com, and we do offer a nice tool where you can pick your state and it will list all of the options you have available for the direct sold plans. And you can enroll right online. It's pretty easy. It doesn't take long. So step two, when you're selecting a plan, once you decide whether or not you want to go direct sold, advisor sold, prepaid tuition, or savings, you want to look to see what your state's going to offer. As we talked about, over 30 states offer an income tax deduction or an income tax credit for 529 contributions. The rules about how these work vary by state. So for example, in New York, contributions to a New York 529 plan of up to $5,000 per year or $10,000 if you're married are deductible for state income tax. That's a pretty generous incentive. But New York has a rule that only the account owner or their spouse are eligible to claim that deduction. There are 7 states where you don't even have to use contribute to your home state's plan to get the tax benefit. And that is Arizona, Arkansas, Kansas, Minnesota, Missouri, Montana, or Pennsylvania. So those states offer a tax benefit for investing in any state's plan. Just wanted to point out though, keep in mind that if the plan has high fees or poor investment performance, that can outweigh the benefits of a tax deduction. As you can see from this slide, the annual tax savings, it's still a tax savings, but you might lose more than that, if you have a plan with poor performance. So it's good to explore all the different factors. General rule of thumb, when your child is young, look for a plan with the lowest fees. Maybe once they get to high school, the tax benefit becomes more valuable. Just remember to reinvest those tax savings because they do not automatically get reinvested. Step 3, research and compare things like the plan manager, the fees, and the investment options. On savingforcollege.com, we have many tools to help you do this research. Including a comparison tool. And as I mentioned, we offer plan details for all state 529 plans. We also publish performance rankings and 5 cap ratings to help you find a plan that's best for you. Right now, I'm going to share a link to one of these tools in the chat so that you can go ahead and explore after this presentation some of the different options that are available. I'm going to go ahead and put that in the chat. So when you're looking at a plan manager, that's going to be, the investment manager that's in charge of the plan. You want to look, something you want to look is the manager's contract up soon, which would leave you with a whole new set of investment options and fees? Or have they been there for a while? Is it a well-known name? Is it someone that you're comfortable with? Those are all things you can find on savingforcollege.com as well. And then also very important is looking at the fees. Even a small difference in 529 plan fees can add up over time. For example, if you invest $100,000 in a 529 plan with a 1% expense ratio, you'd pay $1,000 in fees. But if you invested in a 529 plan with a 0.10 expense ratio, you'd pay only $100 in fees that year. And, that's just a 1-year difference. And we're talking about up to 8 years with a 529 plan. Also, as we keep talking about, is those investment options. You want to make sure that the plan you choose has investment options that are going to help you meet your savings goals. And they will vary by plan. As I mentioned, age-based portfolios are designed to help you maximize college savings. So if you're unsure about selecting your own investments, an age-based portfolio that contains low-cost index funds is going to be a great option for you. You can typically choose an age-based option based on your risk tolerance, whether that's conservative, moderate, or aggressive. Conservative means that that option will have the smallest percentage of equities in the portfolio, meaning the least amount of risk. And of course, aggressive would be the other end of the spectrum. And last but not least, start saving. We all know college is expensive. So the most important thing you can do is to get started. Experts recommend you save at least 1/3 of your total projected future college costs. You would cover the remaining 2/3 with current income, which includes, of course, your income and things like scholarships and student loans. Of course, this pie chart is not set in stone. If you're able to save more, that means you can borrow less. So we're just a general rule of thumb to aim for at least 1/3, and you should be good. When thinking about student loans, it's a good idea to keep your child's total student loan balance less than their expected first year salary. And by doing that, they should be able to pay off their debt within a reasonable amount of time. So things to keep in mind is, cost of the school they want to go to, what they're going to study, what the expected first year salary is. You want to take all of that into consideration when you look at how much you have saved when it comes time for college. And you can calculate your total college cost by using our college savings calculator on savingforcollege.com. Everyone's total costs are going to be different because, of course, it depends on the type of college your child will attend and whether or not they're going to live on campus. It's going to vary. So but I'll give you just an idea. According to the College Board, the cost of tuition, fees, and room and board at an in-state four-year public college was around $22,000 for the 2020-21 academic year. And for private colleges, that was around $50,000. So how much do you want to save each month? Again, that's going to depend, but you can use the college savings calculator, which I will include a link in the chat right now for you to determine how much to save each month for your child. Yeah, and the idea with this is to spread the costs over time, looking at past income, present income, and future income. Martha, do we have any questions on?
We do. And I just want to remind people too, because I see them putting some questions into the chat. If you could please try to put your questions into the Q&A instead, that would be helpful. One thing, so a few people had asked about fees and typical fees. So you can add to this, Katie. I just wanted to say they will vary depending on the plan and the investment options that you choose. I think as a whole, the industry has been striving to bring fees down for 529 plans across the board. But as Katie mentioned, we have information for all the 529 plans, the investment options that they offer, and the fees on those investment options on savingforcollege.com. So people can go there to get more information about that. Another thing that came up in a few different forms was basically the question, Katie, about can you have more than one 529 plan? So can you or should you have more than one 529 plan? Should you have separate 529 plans for different children too? So that comes up often.
Right, and yes, you can. So that's all going to depend on your preference. You can have more than one 529 plan for the same child if you want to. If you have more than one child, sometimes it makes sense to have separate plans. Nothing is going to stop you from saving for more than one child in the same plan. But what's going to get tricky is when you want to withdraw the funds to pay for college, because technically a 529 plan can only have one beneficiary. So when if your child, if you have twins, for example, that might not work because you're going to need the money for both children at the same time, but you can only technically withdraw tax-free for one beneficiary's qualified education expenses. So if you do have older children and you've only been using one plan to save for multiple children, what you can do is open plans for the other children and change the beneficiary and shift the money around. That would work. If you want to avoid that and you have younger children, you might want to start off with separate plans for each child. It sometimes just makes things easier. Some reasons parents might want to have more than one plan for the same child. Maybe you want to have a plan, maybe you're maxing out state tax benefits by using one plan, and maybe you have an out-of-state plan that offers a different investment option. That works too. There's nothing that can stop you from doing that.
Thanks, Katie. A couple other questions that came up. So Rebecca and Candace both asked questions related to, when is it too late to save in a 529 plan? Like if the child is in high school, is it too late? And also, what about using a 529 plan when the beneficiary is already in college?
I think either one is fine, especially if the child's in high school. I mean, if they just started high school, you still have 4 years of high school, and then you can still keep saving while they're in college. So every year you can be putting away money, letting that money grow tax-free. If you're collecting a state tax benefit, you can reinvest those tax savings. It's really, you have a lot more time than you think. Think about it this way, even if you started when the child was a newborn, you're not going to take everything out when they're in high school. You're going to utilize those next 4 years, and 5 years, 6 years when they're in college. So definitely not too late. Another benefit, when the child's in high school, they can better understand what the account is for, and maybe they work a part-time job, and maybe you come up with a percentage of their income that they can contribute as well.
All right, great. We'll save some of the questions for the end, so you can continue. Thanks, Katie.
Okay, so the next section we're going to dive into is talking about how 529 plans affect financial aid. And I think, did we have a poll question on this?
Yeah, we do, Katie. So let me, let me get that up here. So the question is, if you could just, if the audience could respond to this, it's, I worry that saving in a 529 plan may reduce my family's financial aid eligibility in the future. Yes or no? Do you agree with that statement? Launching the poll now. And once we get a good portion of the people responding, we'll share that, and then you can address Katie whether they should be worried or not. All right, voting is slowing down, so I'm going to go ahead and end the poll. So yeah, most people, 65%, said that they worry that saving in a 529 plan may reduce their eligibility for financial aid.
Okay, well, let me take a chance to clear that up. And we'll talk about exactly how that works.
Okay.
So we'll start by talking about the FAFSA, which is the Free Application for Federal Student Aid. And this is the form that you're going to use to apply for college financial aid from the federal and state governments, and also most colleges and universities. So the FAFSA calculates what's called the Expected Family Contribution, or EFC. And that is a measure of the family's ability to pay for college. So in other words, the higher your EFC, the less financial aid you're likely to get, because the school assumes that you have more money to pay for college. So looking at the table that we have on the slide, what you want to pay attention to here is that student assets are assessed more heavily than parent assets. So anything the student has, which could be an Utma account, mutual funds, or any other savings accounts in the child's name, is going to be looked at as, more of it will be looked at as available funds to pay for college. So if you save in a 529 plan, does that mean your child will get less financial aid? Well, a 529 plan will affect financial aid, but the impact is limited, and it's going to vary depending on who the account owner is. So the first $10,000 or so saved in a 529 plan is going to fall under the asset protection allowance, and it won't be counted. And the exact amount is going to depend on the parents' ages. And this is for a parent-owned or a parent-owned 529 or a 529 plan owned by a dependent student. So any amount above that allowance is counted at a maximum of 5.64% of the 529 plan's account value. So it's not very much. Other student assets, which we talked about, such as an Utma account or a mutual fund in their name, those are counted as 20%. So that means 20% of that student's savings will be used against them when calculating financial aid. A 529 plan is reported as an asset. It's a very small one, but qualified distributions are not reported. So, and these rules apply to federal need-based financial aid. And the rules for institutional student aid are going to vary by college. So, Martha, are there any questions specifically related to the parent-owned before I get into the grandparents? Okay, then we'll jump right into 529 plans and grandparents. What I want to highlight is that the rules are changing for the 2023-2024 academic year. As you can see from the table, a little summary here. we get a lot of questions about Grandparent 529s. They're becoming a really popular way to save for college, and for good reason. So with the 529 plan, grandparents can build an educational legacy for their grandchildren while taking advantage of the tax and estate planning benefits. As I just mentioned, so there's a new simplified version of the FAFSA that's going to be released on October 1st, 2022. And that's going to be used to determine financial aid for the 2023-24 school year. And this new FAFSA is going to affect how Grandparent 529s affect financial aid. So basically, 2/3 of the existing questions are scheduled to be removed from the new FAFSA, including ones that asks about cash gifts from grandparents. The updated FAFSA does not require students to manually report cash support. So that means in previous rules, Grandparent 529s were counted as cash support, and they reduced a student's financial aid package by as much as 50% of the value of the 529. Going forward, grandparent-owned 529 plan will not have any impact on need-based financial aid eligibility. So with the new form, the amount of the student's total income is going to be determined by the IRS data retrieval tool. So it will not have to be manually entered. And I wanted to make note that the students' FAFSA every year it includes income and tax information from the prior year. So the 2023-24 FAFSA is going to include information from 2021 tax returns. So because of this prior rule for income reporting, grandparents can start taking advantage of the new rules this year. So in other words, a grandchild will not have to report the distribution that was taken from the grandparent's 529 plan in 2021. And prior to these rules, it would have to be reported as untaxed income. So that was the big concern with a lot of grandparents in ownership with 529s, but pretty soon this issue will be eliminated with the new form. I want to talk a little bit more about Grandparent 529s, but I wanted to pause because I am assuming there might be some questions on financial aid.
Hi, Katie. Yeah, there are. So, all right. So this was actually previously on for the general slide, but Giselle says that my child's 529 plan is under her name. Is it safe to assume it won't be counted against her in the FAFSA?
Well, so it's in the child's name. If the child is a dependent student, it's going to be counted the same way as a parent-owned 529, which is with that minimal 5.64% of the asset counted. Does that answer?
And that's the assets, and then the income part. So the withdrawal.
Yeah, the income will not be counted.
Okay. All right, great. Let's see. Somebody asked, and I think the answer is we're not sure yet, but does the new FAFSA rule make a grandparent 529 the best choice for all kids?
I can see why that question is being asked, especially from this table where you're seeing that it's not reported as an asset or income. I don't know that I would say that it's the best choice for all kids, being that sometimes a parent might want control of the 529 plan account and for personal preferences. So with the amount of the asset affecting financial aids being so minimal, I wouldn't count that as a main reason to have a grandparent own the account.
Great point, Katie. All right, let's continue. I'm sure that there are more questions that'll probably come up and we can handle later if we need to.
Okay, sounds good. Let's move on to talk about 529 plan withdrawals. Because no one wants to pay tax and penalty on their savings. So let's make sure that we cover exactly how you should withdraw and how much to withdraw to be able to keep those tax benefits. So keep in mind that withdrawals need to match up with the qualified expenses paid during the same year. An issue that might come up is if you want to pay spring tuition in January, but you withdraw funds in December. You don't want to do that because you want to withdraw from the same year that you're going to spend the money. So once you finalize the timing and you know when you're going to withdraw, you want to add up your total qualified education expenses. So don't forget to add anything you use to pay K through 12 tuition or student loans, or find all those expenses that would be considered qualified, add them all up. Then what you're going to do is subtract any tax-free educational assistance that you received, whether it's from an employer or somewhere else. So you can't double dip tax benefits. And then you also want to subtract any expenses used to generate the American Opportunity Tax Credit or the Lifetime Learning Credit, which are different federal education tax benefits that might be available to you. You can't use both of those, but if you do use one of them, make sure to subtract them because there's no double dipping. For the American Opportunity Tax Credit, that's the AOTC, the maximum benefit is $4,000. And for the Lifetime Learning Credits, that's $10,000. It's also important to note that if a college issues you a refund for expenses that were paid for with a 529 plan distribution, you're able to recontribute that refund into the 529 plan for the same beneficiary within 60 days. So this came up a lot last year with with COVID, when students were required to go home and they got a refund. You are able to recontribute that money without paying taxes. So as I mentioned before, if your total qualified education expenses is less than what you withdraw, then you're going to have a non-qualified distribution. And those non-qualified distributions will incur a 10% penalty and also income tax on the earnings portion. However, there are a couple exceptions to the withdrawal penalty, such as if the beneficiary dies or becomes disabled, if the beneficiary receives a tax-free scholarship, if they receive educational assistance through a qualifying employer program, if they attend a U.S. military academy, or if the expenses were used to generate the education tax credits that we just mentioned, the AOTC or the LLTC. So in those cases, you won't be charged that 10% penalty, but you'll still be charged income tax on the earnings portion of the distribution. So hopefully that's clear. And then how to withdraw, how much to withdraw. How to withdraw, you can usually request a distribution online on your plan's website. Make sure you know what plan you have and visit their website. You can usually do that online or download a withdrawal request form that you can print out and mail in. And then the plan's going to, generally they let you decide who you want to pay, and you'll have a choice. You can pay yourself, you can pay your child, you can pay the school, or maybe a landlord or someone else for things like rent. We typically recommend that you make the distribution payable to the beneficiary, and that's because they're typically at a lower tax bracket. If there are any non-qualified withdrawals, they're going to be, the withdrawal will be taxed at the beneficiary's lower tax rate. Also, keeping it away, avoiding sending it directly to the college might help you avoid complication with the bursar's office or the financial aid office. So also it could happen where if you make the distribution directly to the college, some college financial aid offices might reduce the amount of need-based financial aid you receive. So while you do have the choice, your best bet is to probably just make the distribution payable to the beneficiary. And the next thing I'm going to cover is what happens if my child doesn't go to college. I know this is a big concern, probably with many of you on this webinar. You're worried about losing your savings. How can I save for the future when we don't know what's going to happen in the future? But as Tim mentioned at the beginning of this webinar, it's highly unlikely that a child will go off into some type of career path that doesn't need a form of education that you have to pay for. 529 plans can be used to pay for a community college and trade school, even some study abroad programs. That you can even pay for some gap year programs. So the list of qualifying expenses is so broad, and the chances of you needing the money, I would think for most people is pretty high. So there's not too much to worry about as far as whether or not you're going to use the money. If for some reason you don't, you can always change the beneficiary to a qualifying family member who will attend college. Maybe you have more than one child and the sibling can use the money. Maybe your child wants to go on to graduate school. Maybe, they get a scholarship for undergraduate. You can use the money for graduate school. You can even further your own education if you want to go back and take night school at a community college. Some people want to keep the money in the family for generations. You can save for a future grandchild. And, last resort, you can always take a non-qualified distribution. You will be subject to ordinary income tax on any earnings in the account. Of course, that earnings portion is going to be more depending on how long you've had the account and how long you've been contributing to it. And then you'll have that 10% penalty. But that being said, the amount you contributed is never going to be subject to tax or penalty. So hopefully that clears up that question, which I'm sure a lot of you have been asking.
You're right, Katie, that did come up a number of times. So thanks for getting to that. And is that the end of the presentation?
It is. So we can open it up to Q&A for the last 10 minutes or so.
Awesome. Great. All right. And we'll bring Tim back in. So Katie, thanks so much for taking us through all of that. So I have definitely there, as often happens, I know there are more questions than we'll be able to get to, even having asked you a number of questions along the way. But let me also get Tim in here in some of these. So Tim, please be sure to unmute yourself. So one of the things that came up was who can open a 529 plan for whom? What relationship does there need to be? So Tim, can you start out addressing that? And I think you might still be on mute, Tim. There you go.
I'm back with you.
Right.
Yes, the short answer is anyone. Typically, as we've talked through this webinar here, it's parents, whenever a baby's born, they'll open a 529. That's ideal. That's not always the case. Might be grandparents. Could be aunts, uncles, anyone who maybe wants to help a child to be their beneficiary. So anyone can open a 529. And it came up about the tax benefits, and as Katie alluded to, it varies from state to state. But for instance, in Ohio, you can take up to $4,000 per beneficiary if you're an Ohio resident investing in Ohio's 529 plan. So if it is an aunt and uncle that's giving that gifting, or another family member, if you contribute towards that, you can take advantage of Ohio's tax benefit. And the $4,000 is not a max contribution limit. As Katie said, the range for contributions is minimal of $25. In our case, in Ohio, it's up to $501,000.
Great. All right. Thanks so much for that, Tim. By the way, I want to call out one of the questions came with a Go Buckeyes attached to the end of it. So, all right, Katie, going back to the very start, somebody had asked about, that you'd mentioned the Roth, but they were curious about how can Roth be used to save for college. So could you just quickly run through that again and how it compares to the 529?
Sure. Well, first of all, I think we should note that the 529 is specifically designed to save for college, where a Roth IRA is a retirement account. So the Roth IRA is not going to have those age-based asset allocation options that you can choose from that are designed to help a child save for college. So I think that's the most important thing. But when comparing the tax benefits, the investment accounts work similarly, where the investments grow on a tax-deferred basis. And in certain situations, you have the opportunity to withdraw everything tax-free. The difference is with the 529 plan, you can withdraw tax-free at any time as long as you're using it to pay for education. With the Roth IRA, you are going to be able to withdraw your contributions at any time. But the earnings, there's some rules regarding when you can withdraw the earnings tax-free, and that is you have to be 59 and a half years old and have the account for 5 years. Or there is a special exception where you can withdraw to pay for qualified college expenses, but you're still going to pay income tax on that withdrawal. You just won't pay the normal penalty for early withdrawal that you would have paid otherwise.
Great, thank you. That's very helpful. Katie, one more quick question for you. Someone asked, is there an advantage to having a 529 plan in the state where you think the child will go to college?
Unless you're using a prepaid tuition plan, that probably doesn't matter. I can't see any reason why that would matter, because yeah, you can use a 529 plan to pay for any college in any states. And even if you're getting a state tax benefit for using your home state's plan, that would not matter if the child is going to a college in another state. But as I said, if you're using a prepaid tuition plan, some of those are designed to help you pay for an in-state public college. But yeah, if you're using a savings plan, no.
Okay. Tim, I'm going to turn back to you. So when Katie was discussing the financial aid implications and grandparent 529s, several people asked, what happens if a grandparent who owns a 529 passes away? So what happens in the case of death to the ownership of the 529 plan?
Yeah, regardless whether it's grandparents or parents or whoever is the account owner, encourage and be aware of that, because every plan has this, is a survivor who would take over that account as a survivor. And please identify that person, because in the event that happens and no one's designated, it becomes more complicated. And so the best thing to do is to designate who assumes the account in the event something sad like that happens. And then you'll be covered. The beneficiary will still remain the same. It's just the account owner, would change in the event of those circumstances.
Got it. Thank you. Keeping an eye on the time. We still have a few minutes. Let's see. I don't know, Tim, if this is for you or for Katie, but someone asked about when it comes to withdrawal and taxes, do I have to keep receipts for taxes? What if I give the money directly to my child? Do I give it as needed for expenses? So David is asking that.
I can take the first part of that, and Katie can weigh in. We would advise keep your paperwork, because in all likelihood, you're doing a qualified withdrawal. There's a tuition to be paid. Katie didn't get into that, but let's say for room and board, the rules are that you can take up to the amount that the education entity is charging for room and board if you're living off campus. And so, keep those receipts, because in an event that you are audited or somebody would question that for whatever reason, you can say, yep, here's what we paid for tuition. Here's what we paid for a computer. Here's what books cost us. Here's what the landlord charged for rent. And so it's advisable to hang on to those receipts. And thankfully, it's not a common occurrence, but you never know when an audit may come about.
Katie, anything more there?
Yeah, I'll just kind of reiterate what Tim said. No one's going to be checking those receipts. You don't have to submit them unless there was some sort of audit, but it's good for your own record keeping and, of course, just in case.
Right. So you don't have to submit them for tax purposes, but in the case that there's an audit, you need to have proof that it was spent properly, right?
Mm-hmm.
All right. Okay. A question came up. Somebody asked, what is the New York ABLE program? And I don't think we talked about ABLE plans. So maybe just quickly, Katie, you can mention, because there might be some confusion because they're also under 529. But maybe you can mention that, like what ABLE is versus a 529 college savings plan.
Mm-hmm. Sure. So ABLE plans, it stands for Achieving a Better Life Experience. And those plans are designed to help save for not only education expenses, but different living expenses for individuals with disabilities. So they work similarly to a 529 plan, but they are a different vehicle for a different purpose. We do have some information about ABLE plans on savingforcollege.com. So I encourage you to check it out, because there's different rules with different benefits that individuals with disabilities receive from the government, and an ABLE plan can help you maximize those benefits while still helping that person save.
Great. Tim, we're just about almost out of time. Any last words of encouragement or advice for our participants today?
Yeah, as a theme, and we started this, is we urge you to save. We invite you to look at our plan, but if it isn't our plan, look at a 529, because again, the student loan debt is staggering. And, and the thing of it is to have a plan. If a 529 isn't for you, have a reason for it. I met a gentleman recently who has rental properties. And I asked him about 529 because he has a teenage son. He goes, well, I'm going to sell one of my properties to pay for that. Well, that's good. That's a plan. And, and he, deliberately was not doing a 529 because that's what he's going to do. Or I went to a concert with pre-pandemic, and Greg Kihn was coming up and play his most popular song, the breakup song. He goes, here's a song that sent my grandkids to college. You may not have those resources available for you. And so look at savings and investing. And if you're not choosing a 529, know all the facts about it as we presented here today, and you've made a deliberate decision not to consider 529. And one last thing about on our webpage and calculator, you can plug in a specific school. If you're looking at, say you live in Ohio, you're looking at University of Akron, what's that going to cost in 2030? Or what's the Arizona State University going to cost in 2030? You can plug those in, and everything in between. As we said, for trade school, technical school, colleges, there's even a dolphin training school that qualifies for federal financial aid, and you can look up how much that would cost if your beneficiary is looking to go there.
Oh, fantastic. Okay, and people can find that at collegeadvantage.com.
Yes.
All right. Okay, well, I want to thank everyone, all of our participants, for spending the hour with us and asking really great questions. Thank you, Katie, and special thanks to Tim Burrell and our sponsors at Ohio's 529 plan, College Advantage. And I want to let you know about the slide you're seeing right now. College Advantage is kicking off National 529 Day by giving away 2 College Savings Awards in partnership with 2 of Ohio's professional sports teams. So there's one $10,000 Grand Slam giveaway with the Cincinnati Reds. You can get more information at this URL. And the second $10,000 college savings giveaway with the Cleveland Indians. So the first one is collegeadvantage.com/Reds. Second one is collegeadvantage.com/Indians. Go on, learn about it. And as Tim said, look into 529 plans if you don't have one already. Hope we were able to help you out with some information today. Thank you, everyone.
Thank you.